Welcome, everybody, to today's Berkle Center Book Talk. A few announcements before we begin. Today's webinar is being recorded, but only the speakers are visible and audible. The audience cannot be seen or heard. Both the video and audio recordings will be available on the Berkle Center website, as well as on YouTube and in Apple Podcasts. We invite you to submit your questions through the Q&A portal that's located at the bottom of your screens. Also in the chat box which is available by accessing the bottom hand of your screen, you should be able to access information about ordering the book. And we'll also be posting a discount code that you can use in order to get a discount off of the book. So today's speaker is Dincecco Queralt. He received his PhD from New York University, which I have a personal bias in saying is the best PhD program in the world. He's currently an assistant professor in the Department of Political Science at Yale University. He's a talented young political economist, and his research examines historical political economy of fiscal institutions, and he examines them from three different angles: through the intersection of war, trade, and external finance. He's already published research articles in a number of different top journals, but today he's going to be sharing with us research from his first book, which was recently published by Princeton University Press. It's titled Pawn States: State Building in the Era of International Finance. So I'll go ahead and turn things over to Dincecco.
Thank you very much for the warm presentation, and I agree. NYU offers the best PhD program in the world. I'm very happy to present my work today. And basically, I want to start the presentation by breaking some news. That's basically that there is a problem with public debt in the United States. And if you've been reading the news lately, you'll basically have probably learned that we hit the debt ceiling. And now there are negotiations between the presidency and Congress about whether to raise the ceiling. And if that negotiation does not move forward, the United States will default on its sovereign debt for the first time ever. And that will be a big event, not only for the American economy, but also for the entire world. Speaking of the world, the problem of sovereign debt is far from a problem of the United States. It is a very normal or often problem in the poor countries, and that's because they are relying increasingly more on external finance. On these two charts that were also drawn from recent news, we see on the left that external indebtedness of developing nations has actually more than doubled in the last 20 years. And more problematic on the right chart is that these countries are having a harder and harder problem to pay back, to service their debt. And some of them are very close to default. And many bad things usually happen when countries default. And those things should be and are actually of interest to the political science community. There are many interesting questions for the PhD students in the room that we should address as political scientists. What are basically the causes and consequences of default? And in the book that I'm... Yes?
I think you need to share your screen with us. I don't think you've put up slides, although I know you're talking about them.
Yes, sorry about that. Here we are. Yes. So back to where I was. There are important political science questions that we need to address when we assess the consequences and causes of default. But in the book that I'm presenting today, I try to address a slightly different question. The first one is, when did the problem of external indebtedness rise? Is it a problem that began 20 years ago? Is it a problem that began 40 years ago? And also, what does it mean for domestic sources of revenue? And in particular, what does it mean for taxes? When countries float loans overseas, does taxation increase in order to repay the debt, or does it decrease? And if it decreases, what is the risk of falling into a debt trap? The questions to the answers to these questions make up Pond States, the book. And in the book, which I structure in mainly two big sections, I first unveil and explain the conditions of access to external credit markets of the developing world, starting as early as 1816. I also examine what are the political dilemmas for sitting incumbents, whether they decide to float loans to fund fiscal shocks, or whether they prefer to raise taxes. And basically, I come to the conclusion that most of the times, external finance weakened incentives to build tax capacity. So there was a substitution effect between external finance and domestic finance. And I also evaluate the long-term effects of early access to external finance. And in the vast majority of cases, I find a negative effect between early access to finance and long-run fiscal performance and democratic institutions. So let me walk you through the different parts of the book by starting with the very origins of the globalization of public credit. So this brings us to the early 19th century, to the years after the Napoleonic Wars, so 1816 onwards. This is a period in which newly independent countries and countries that had existed for centuries and millennia, but had been traditionally isolated. This is a period in which these countries initiate state building programs that require funds. They need money to build new militaries, to build infrastructure, and eventually to refinance old debt with new debt. And these countries are in Latin America, but not only Latin America. Countries in the Middle East, in the north of Africa, and in Southeast Asia are also participants of this early market of international credit. This demand for external finance was easily met in European financial capitals, and in particular in London, in the London Stock Exchange. And that's because the Industrial Revolution had created a big surplus of capital, and these capitalists, the investors, decided to lend money at a price to these nations that require vast amounts of resources. So it's important to remember for the presentation and for the implications of this early access to capital that the contracts were private. These were contracts that were signed between European capitalists, private investors, and foreign sovereigns. Most of the lending nowadays is between multilateral organizations and borrowing countries. That's what we call official lending, but that was not the case in the 19th century. Those contracts were private, went from private hands to public hands. The first basically task that I conduct in the book is to understand what were the terms under which these new nations access credit in financial capitals. And for that, I put together an original data set for 92 polities, including sovereign states and colonies between 1816 and 1913, involving more than 940 sovereign bonds. And the main conclusion that I come to is that capital was issued at comparatively cheap terms. There are different ways to look at this or to come to this conclusion. One is to look at what is the average interest rate in the European credit markets before the 19th century. and compare them to the average interest rates to the international credit markets post 1800. And this is basically the figure that you are showing, that you are seeing on your screens. What we see here is that the average interest rate declined over centuries in Western Europe, and it continued once the new participants in international credit markets joined the capital markets. And this is already puzzling, because many of these new borrowers were countries with weak economic fundamentals, with high political instability, and also without any reputation in international markets. Another way to look at the basically the conditions under which new borrowers access their capital in European markets is by comparing the average interest rate of bonds floated by European countries, those that had been floating loans for 700 years, to non-European countries, to countries in the so-called global periphery. What we see is that the difference in the interest rate between these two groups was under 100 basis points, which is it's a small difference for historical standards, but also for modern standards. And what is even more puzzling is that the spread between, that is the difference in the interest rate, in the interest rate between these two countries, vanished in the last decades of the 19th century. And in case you wonder, the results hold when we look at the effective interest rates. So we should not be particularly surprised to know that many of these countries in the global south defaulted, and basically they stopped paying or servicing debt when they were supposed to. And this is not something that I unveiled. This is very well documented in Reinhardt and Rock of 2009. So the puzzle is why European investors, and in particular British investors, were willing to lend to countries that had a high probability of default. To answer this question, I advanced the notion of extreme conditionality, which was the practice of collateralizing or asking borrowing countries to collateralize, to pledge public assets in order to access fresh capital, under the understanding that in case of default, the bondholders, the investors, would foreclose the collateral and run it and manage it until the debt was liquidated. So you might be wondering, what were these pledges? What was collateralized and foreclosed? So I classify those assets into two big categories. These were branches of the tax administration, and those bond assets happened in big countries like China, in smaller countries in Europe, in smaller countries in Latin America, and basically everywhere in the world. And another type of asset that was foreclosed was state monopolies. Basically, these were the main sources of revenue in the global south, and we find examples of this foreclosure in countries like Bulgaria, El Salvador, Paraguay, Portugal. So this was a really frequent event. At this point, we need to address two questions. The first one is why incumbents in the global south were willing to accept extreme conditionality, and also what was the enforcement mechanism of extreme conditionality. So let me walk you through the main ideas behind these two questions. So first of all, we all agree that pledging public assets was highly unpopular already in the 19th century. And there are examples of presidents trying to hide it from the press and to hide it from the parliaments. And actually, they were not obliged to issue loans and pledge their assets. And there are examples of that in Ethiopia and in Thailand, then Siam. And those are examples of cases in which the sitting rulers were afraid of the consequences of default because they were seeing what was happening in other countries, and they decided to invest instead in their in building tax capacity. But we need to understand that the costs, we need to understand the costs of the alternative to external finance. And those are basically that investing in tax capacity, in building a professional tax administration, in centralizing and standardizing the weights and measures across the territory is costly, is a very invested exercise that consumes a lot of resources. In countries that already had problems to basically get to the end of the month. And depending on initial conditions, resorting on taxation could basically involve the mobilization of taxpayers for granting them political rights, the notion of no taxation without representation. So once we assess the advantages and disadvantages of external finance and loans, we basically end up with a simple prediction, which is summarized is articulated actually in the second chapter of the book, which is basically that incumbents in countries with high political instability, incumbents in countries with loose executive constraints, you can think of authoritarian countries, and countries with initial weak fiscal capacity were those that were more likely to prefer external finance over local taxation. So basically the takeaway of this discussion is that countries with poor initial conditions were the ones that were more willing to pledge their assets and end up with a poor fiscal policy. The second important question that we need to address is what was the enforcement mechanism of these of these private contracts in international markets, or put it in different words, why conditionality was credible. And what I argue in this fourth chapter of the book is that basically in the last decades of the 19th century, bondholders, particularly in Britain, gained the ability to enforce conditionality because three conditions were met. First one is that they overcome coordination problems by creating the Corporation of Foreign Bondholders. This was what nowadays we would call a lobby that basically specialized in negotiating with countries in default, but also specialized in lobbying the British government for diplomatic assistance. So they were basically trying to bring the British government to the table in order to extract these concessions from the borrowers. The second condition is that this is a time in which there was a significant elite replacement within the British government. So the second half of the 19th century makes very clear that land is no longer the main source of wealth in Great Britain. It is the industry. It is basically the Industrial Revolution, and that basically leaves the landed aristocracy with few options, and they decide to switch sectors. And the two sectors that they reallocate to are banking, and the other one is the executive branch of the British government. So by occupying these positions, basically what we find is a natural or quasi-natural alignment between the interest of finance and the interest of the national interest. And this has to be added to the third condition, which is the context of imperial competition between Britain, France, and Germany. France and Germany were very open about using external finance as an imperial tool. That was not the case for the British government. But at some point, they realized that because 2/3 of their wealth, of all British capital, was invested overseas, they had to do something. They had to counteract the French and German intervention in international credit markets. So maybe reluctantly, the British government decided to participate in these default negotiations, and together with conditions 2 and condition 1, turned conditionality, this extreme conditionality, credible. So in addition to some qualitative evidence to validate this mechanism, I also ran a large and statistical analysis in which I regressed the presence of specific pledges in the loan contracts on the interest rates associated with those contracts. And for that, I had to hand code over 700 loan prospectuses and basically differentiate what type of pledges were collateralized. And the main result of this statistical test, which basically relies on two-way fixed effects, is that the presence of a pledge reduced the premium of paid by a borrowing country, and this basically grants credibility to the to basically the extreme conditionality mechanism. So the second part of the book is about what are the consequences for state building of having basically early access to external finance. And in order to summarize basically 5 chapters of the book, let me introduce this diagram to basically help me elaborate on the second part of the book. So here, think of a fiscal shock, and basically war comes to mind as being the paramount example. And rulers have to finance a war, and they have 3 options. They might tax, they may issue domestic debt, or they may rely on external debt. So if we focus on the first 2 paths, tax and domestic debt, those are basically the paths which basically I denote as paths A and B. Those were the paths that most Western European countries followed before the first globalization of international capital in the 19th century. So those were the paths that, if you read Tilly, the work of Charles Tilly, for instance, or the work of Northern Weingast or David Stasavage, those are the paths that these European nations were following before this globalization of public credit. What is important is to understand that either taxation or domestic debt puts in motion political mechanisms by which those that lend to the crown or those that pay taxes can hold the ruler accountable. If the ruler doesn't use the tax money or the debt in a proper way, responsibly, the taxpayers and the lenders can basically choose another ruler. That's basically why we associate the rise of taxation and the rise of domestic debt to power-sharing institutions and also state building. Because in anticipation, rulers invested in the tax administration in the country in order to repay the war debt. Now, what happens in the 19th century? What happens is that this additional path comes to exist, the path of external debt, and 3 things could happen once they relied on international finance to finance to fund fiscal shock. Countries might tax after war and basically close the circle and end up in state building. That would be a clean contract, and basically Japan comes to mind in order to illustrate path C. Or they might negotiate with borrowers after default, and maybe some haircut and some conditions to extend the time that they can repay, and eventually they will make a fiscal effort to collect enough taxes and pay back the debt. That's the path D, which I associate with the IMF these days, with the work of the IMF. But in the 19th century, because of the international context, path E was also a possibility. That is the swap between domestic sources of revenue, domestic monopolies and branches of the tax administration for all debt. And because the main sources of revenue were put in hands of international investors, there was no building in the state. Actually, it was the opposite, because countries needed to go back to international capital, to international credit markets. They had to collateralize new assets. And because the tax base had narrowed, they were more likely to default and basically fall back into this negative cycle of state building. So the second part of the book shows some evidence based on vignettes that basically are associated with each of these paths. It also shows examples, it also includes large N statistical analysis for the short and long run effects of early access to capital. And basically it shows that the way that war was funded in the 19th century affected fiscal institutions in the 19th century and all the way till the present. And it also elaborates on the mechanisms of transmission, meaning the reasons why early fiscal decisions affect fiscal capacity in the present day. And I'm really happy to tell you about that in the Q&A. But because I'm running out of time, I prefer to wrap up the presentation by sharing with you my interpretation of external finance, which is not very positive nor very negative. What Pawn States tries to do is to offer a cautionary tale about the opportunities, but also the risks associated with financing government overseas. Now, you might want to know what are the implications for today. So importantly, extreme conditionality is no longer a possibility. After World War I, in the international context changed dramatically. Happy to tell you more in the Q&A. So extreme conditionality does not apply in the present day, but we should care still about it because it helps us to understand why weak states exist today. It's one of the causes of weak states in the developing world today. Now, I'm happy to tell you more about how I interpret this. How can we use the lessons of Pawn States to basically validate the skeptic claims about foreign financial control. Basically, it involves the same type of dilemmas for state building that we are seeing today in the developing world. It is very hard to build states by foreigners unless basically the agents inside the polity come to believe that they all benefit from a stronger state. It is very hard for them to build a state. And just let me end by saying that what Pawn States tells us is that when we talk about the oil curse, or the more basically generally the easy money curse, we should not only think about oil and aid, we should also incorporate external finance, because at the end of the day, it distorts political accountability in very similar ways. And with that, I'm gonna leave it here, and I'm really happy to address your questions. Thank you.
Wonderful. Thanks so much, Didac. Wonderful. If you maybe want to unshare your screen, then maybe it'll take us back to the normal presentation mode. Okay. So I imagine that based upon, first of all, for everyone in the audience who's our guest today, just a reminder, if you want to go ahead and submit responses or questions, just go ahead and push the Q&A button at the bottom of your screen. It'll go into sort of a box so that I can see the responses coming in. Based on the ones that have come in so far, I imagine that most of the questions that we'll be sort of fielding in our discussion will relate to sort of the implications of Didac's argument and evidence for the contemporary world. So just sort of a heads up for you, Didac. But I do want to ask you a little bit about your last slide and your notion of, you said extreme conditionality no longer applies after World War I. Because, obviously, I've read a little bit about the 19th century. I'm not a Didac Queralt, but the thing that those examples bring to mind so much for me is when I'm reading today about China's Belt and Road Initiative. What is so striking to me about reading about that particular aspect of modern debt contracts
Mhm.
Is the way in which China has been systematically structuring its debt contracts is that it is explicitly making these infrastructure loans conditional on pledges of things like ports and harbors, such that if these infrastructure loans aren't paid back by the developing states, that China is claiming that they are going to be given access over portions of sovereign territory in these states. So
Mhm.
is that not sort of a resurgence of this idea of extreme conditionality? I know it hasn't been fully realized yet, but
Mhm.
it
Mhm.
seems like that's what's really causing a lot of concerns about the Belt and Road Initiative, is this idea of extreme conditionality coming back. No?
Mhm.
Yeah.
Yes, yes, I agree that there are many things that we see on the news that resonate with the argument that I make in the book.
Mhm.
Now, I'm open to the possibility that what China is doing to countries in the global south was similar to what European nations were doing to China in the late 19th century and early 20th century, which would be kind of ironic. Now, being open to the idea, I intentionally avoided a strong claim in the book, because if we've learned anything about these contracts, is that there is a lot of opacity, right? So there is this uh, super interesting report by Anna Gelpern and co-authors titled "A Look at 100 Chinese Loans,"
Mhm.
as very close to that, or very close to that. That basically the main conclusion is that we don't really know what's going on, right? So
Okay.
until we learn, I mean, the fact that those contracts are so opaque is
I
not a good sign to begin
okay.
with.
Mhm.
To begin with, but I think that it's a little premature to come to this conclusion. I think that more
Important.
research has to be done, and basically that we still don't know. It can be the case
Okay.
that history is repeating,
Yeah.
but we don't have enough evidence, in my opinion, to make a very strong case still.
That's important. Yeah, of course, we should acknowledge, this is largely sort of based on journalistic reporting. To my knowledge, I don't know that anyone's ever actually seen the text of any of these contracts, right? Yeah, these are
Yes.
largely based on journalistic reports. Okay, so we've gotten a lot of questions in from our audience. I'm going to do my best. I don't know that I will necessarily present these in a logical orders. So from one of the graduate students in our audience, are there cases where the indebted country refused to allow the debt holder to collateralize the debt? Like if the UK was supposed to take over a monopoly in an indebted state, but the state refused. Were there examples of sort of resistance whereby states sort of pushed back? I mean, I know there were definitely uses of force by European states, right, to collect on the loans. That's
Yes,
true,
yes,
right?
that's true. So that's yes. So I just want to clarify
Yeah.
that it wasn't the British government which took control of the assets. This was the private investors, but
Okay.
they had the help of the British government. But
Mhm.
so that's why I emphasize at the very beginning that these were private contracts.
Mhm.
So just to keep like things as clear as possible. Now, yes, there are examples Venezuela, there are examples Egypt, there are examples Mexico, even the Ottoman Empire, in which there was basically a clear expression of force, and we should acknowledge them. Now, gunboat diplomacy, that's how it's referred to in the literature, was exceptional. And some authors come to the conclusion that because it's happened rarely, this idea that the British government would step in and help investors is not valid. My interpretation is the opposite, that these episodes are of equilibrium path results. So when things didn't work as expected, that's when we see gunboat diplomacy. But
okay, so you're not buying sort of the Mike Toms story.
I see too many examples in the literature, in the historical literature, to claim that gunboat diplomacy means that there was no conditionality.
Yeah. Okay. One of our guests asked if you could elaborate more on your point about geopolitical conditions terminating the practice of extreme conditionality after World War I. What exactly do you mean by that? Yeah.
Yes. So this is basically based. There are like two major changes. The first one is the Drago doctrine.
Okay.
Drago was the Ministry of Finance of Argentina, and he was involved in the renegotiation of debt in the early 19th century. And basically, he was also a scholar, and he basically made the case and appealed to other developing nations in the world right before World War I that gunboat diplomacy and the coercion exerted by European powers should not be the way to resolve debt disputes. And basically,
but you also have the Calvo doctrine competing at the same time. Come on. I don't know if I'm believing that, Deduct. I mean, yes, I agree that Drago existed, but I also agree that not everyone agreed with him, right?
Yes, but
okay, but I'll give you half a point on that one.
Okay, so okay, good. The second one brings us to the 1970s, and basically at that time, the courts in the States and also in the UK basically relaxed the idea of absolute sovereign immunity, meaning that they would be willing to accept, they would accept cases in which the investors of defaulted bonds sued sovereign nations, right? And that basically it offers a legal channel, a non-coercive channel to resolve these episodes. Yes, also importantly, we might have seen a very different scenario after World War I if external finance was as big as it was before World War I. What we see is that after World War I, the international credit markets go back to not to zero, but basically they do not operate at the same scale as they did before World War I until the late 70s. So we have these 60 years in which this, so the counterfactual is kind of, yes, I agree with you that I have only half a point, but I just want to go for a quarter more of a point by saying that the counterfactual is not super clear because many things change at the same time.
Yeah, of course. And then you have all kinds of development aid. I mean, states are financing through different means, right? They're not necessarily, they're going through different channels. They're not necessarily going through external debt through private markets, right?
Yes.
Yeah. So anyway, I love you for sticking up for Drago, though. I mean, not a lot of people even learn his name, right? I see so many books that just go with Calvo. They don't even mention Drago. So good for you. Yeah, I love that. Okay. So a question from Art Stein. The argument about the credibility of extreme conditionality is a late 19th century story. But the role of external finance was seen throughout the century and had no state enforcement behind it, and thus should not have been credible. So what explains the early part of the 19th century?
Well, what we see, two things happen. One, we don't see pledges having any effect on the price of credit before these conditions, that before the creation of the Corporation of Foreign Bondholders. That's one thing. So, and the other one is that we also see a rise in collateralization after 1960. So it's you see it growing. So I mean. That's basically why you see some external finance in the first half of the 19th century, but it grows over time. And the point of the book is that it grows because they solve this credibility problem. So the investors feel more confident that they are going to recover their investment.
Yeah, and corporation for foreign bondholders, that's 1868-ish. Is that right around there? Okay, okay.
Yes.
So do you believe that the current international financing market maintains imperialist legacies? And what controls, if any, are necessary to combat this dynamic?
Well,
I mean, that's a big question.
Yeah,
I don't know that anyone can answer that. That's like, you know, a lifetime's work. That's a really big question. One of our guests is asking you.
No, it makes sense. I understand where it comes from. So we would need to define what imperialism aspect means. But what I want to clarify, so there is this fantastic book by Jonas Bunte, who basically documents the type of lenders in nowadays credit markets. And there is this figure in the early, maybe the second chapter, that shows that less than 10% of sovereign of lending to countries nowadays is purely private. So there is a lot of official lending, and lending that is both official and private. So basically you have official institutions, multilateral institutions and banks acting together and lending together. And I want to believe that the conditions in the new international credit market are less interested in the favor of recovering the investment and give way more weight to building capacity in order to repay the debt.
Okay. So I guess one thing, this is coming up in some of the questions, and it's also sort of a question that I had when I was reading the book, is it was often sort of presented in the book, this idea that there was sort of like this fiscal shock, like this, like, oh, a war comes along and you're just sort of presented with this pressing need for money. And you kind of have to choose, like, am I going to tax? Am I going to, you know, sort of go through domestic debt, or am I going to go through external debt? But and I know this is asking you to step outside of your theoretical framework, but are there sort of alternatives for countries to sort of avoid the consequences of easy and early foreign finance? You know, and isn't it a little bit artificial to sort of think that you know, oh, you just have sort of like the sudden need for like money that must be burned, right? Because it wasn't really sort of an option within this framework to like, oh, I'm gonna take out a loan and I'm gonna use it to grow my economy, right? There was never sort of this, at least within this conceptual framework that you presented, that like, I'm going to take external finance, or I'm going to take domestic debt, and I'm going to use it for a productive purpose, right? There wasn't really an opportunity for growth. So obviously that introduces a more complicating factor within your model, right? But it also creates new opportunities for these states, right? The potential to use debt responsibly. So, right, how does that complicate the story? Yeah.
Yes. So one of the aspects that I articulate in chapter 2 is that that world in which a country manages external funds responsibly is more likely to happen when you have power sharing institutions, basically, that hold the ruler accountable, and in situations in which you have strong tax capacity, in the sense that you know for certain that you will be able to repay, because basically that simplifies things, and then you can spend your time thinking in how I grow the economy, right? Now, my main disagreement with economic historians studying external finance in the 19th century is in the role of railroads, which was basically the big developmental finance at the time. There are a few examples that railroads help to grow economies. There are the case of Mexico, the case of Argentina, and the case of Brazil are usually offered as examples of that. But the problem, and here I'm also quoting the work of other economic historians, is that those investments grew the economies, basically caused economic growth, but also economic underdevelopment, in the sense that these infrastructures were built not to create domestic markets, not in a rational way in which you would basically overcome market failures, but those investments you often prioritize extractive industries. So basically, at the end of the day, you had railroads, which otherwise sound like a good investment, that were used to extract resources from countries and bring them to Western Europe. The worst case is not only that, is that many railroads were actually foreclosed by international investors, and that meant that they had very little incentives in maintaining the lines. So many of those railroads shut down after they had liquidated the debt, and basically they left behind an infrastructure that did not work. So it is hard sometimes to find any positive legacy of that investment in developmental finance in the 19th century.
Okay. Okay. Meaning you're saying that even though, meaning your argument is that this money, you would say was not invested in a productive way, and that it was just sort of sunk and did not generate productive revenues? I'm sorry, yes. I don't understand what you're arguing. Yeah.
So let me, for instance, bring like the case of Spain. So the railroads, so there were some early railroads that were well planned because they were meant to unify the market. But those were the exception. Most of the later railroads were lines that connected extraction sites to ports.
Okay.
Right? So if you basically, but that didn't generate any market, right? That didn't connect any market. Okay. Those were basically expressions of extractive investment. Okay. Right? So you could count it as growing the economy. It grew the GDP, but basically it distorted the entire economy. Okay. Because rather than investing in sustainable economic growth, basically those railroads attracted resources for the growth of very narrow economies that at the end of the day were computed or basically fill the pockets of international investors. That's why that's this idea that yes, you can grow the economy, but at the same time you can cause underdevelopment.
I see. Okay. Very good. I guess we have about 10 minutes left. Since we have a lot of graduate students I know who are attending today's talk, I guess I wonder, if you have any sort of general advice you might share to them in terms of, I think you're sort of, a relatively young academic, very early in your career. And I was wondering if you had any advice to them to share in terms of, doing work that crosses disciplinary barriers. I think you're a great example of someone who was trained as a political scientist, obviously does work on economics, does work from a historical angle. I was wondering if you had any advice to share to them in terms of, speaking to multiple disciplines, trying to satisfy multiple constituencies, issues like that.
Yeah. Well, don't do it.
Don't do it. Don't do it. Give up.
It's hard. It's hard. Sometimes, sometimes I think why didn't I just take a simpler road? One that
I will say for the graduate students, Didak, you've had a bit more of a circuitous path. I'll share that. Like you did a couple postdocs, right? You've been like a visitor at a couple of different universities.
Yes.
You've worked in Spain. Like you've traveled quite a bit. You've had a challenging path, I think it's fair to say, right?
Yes,
You
yes. I
didn't
went back
go
to
straight
Spain.
from NYU to Yale, you know,
No,
like
no.
yeah, you've worked
Yes,
hard.
I worked hard. This is the book is not my dissertation. The dissertation came out as basically in the form of papers, and it relates to trade, not to finance. So I mean, I'm joking. I in the sense that trying to speak to different disciplines is challenging. It is exciting because you learn things that you were not exposed to during grad school. But it's not the easiest path, and at the end of the day, you might be perceived as an outsider when you try to speak to economic historians. So that's why it's hard. But at the same time, and this is the advice that I give to everybody doing a PhD, no matter the research question, I think that people should focus on topics that they feel passionate about, because that's the only way to move forward. Grad school and the profession is getting more and more competitive. I mean, the standards are raising every year, and it requires to put a lot of effort. So you better like what you do. I wouldn't chase fads. I would chase interests, and some interests are easier to implement. Others are harder. And in my case, I would have not been able to write this book right after completing my PhD. It's a project that took me a little longer than that. But at the end of the day, I'm happy with the outcome. But it wasn't a piece of cake. It wasn't to me. Maybe it is for other people, but it wasn't for me.
Well, I think it was an effort well worth making. I certainly enjoyed reading it. I have it right here beside me. Again, for those of us who may have joined us a few minutes late, if you go to the chat box, you can access the book's website. And Didak was generous enough to contact the publisher and provide us with a discount code that you can access through the chat box. So please feel free to use that and get a discount. Thank you so much, Didak, for joining us today and sharing your research with us. Thank you to everyone in the audience for coming and joining us for another Burkle Book Talk. And we look forward to seeing you again when our next author joins us. Goodbye, everybody.
Bye.